Hello again. Welcome back to Money Corner. Last Wednesday, I had an opportunity to go down to Washington, D.C. I appeared with a group of people from Bergen County and talked to members of the congressional delegation from New Jersey, both senators and congressmen. We were having lunch and I was startled because one of the women turned to me and said, "I know that you're a stockbroker. What do you think of an annuity?" And she mentioned an annuity, a product that really was a fairly sophisticated product, and she very quickly said, "Do you like it? Yes, no." And I realized it's just unfair to give glib, quick answers to questions like that. And after listening to her talk, the thought occurred to me, and my guest tonight is really in response to that situation. My guest is a regional product specialist for Merrill Lynch in charge of insurance and insurance products. And his primary function is not so much to meet with you, members of the public, but rather to educate people like myself, the Merrill Lynch salespeople, on insurance products and the intricacies of insurance. And one of the reasons I invited Ed Bayarski of the Merrill Lynch's Paramus office to talk to you tonight, because of the wide variety of products that are being presented to the public, and I think in many cases the public winds up being confused. Ed, I don't know if you agree with that observation or not, about confusion because of the amount of insurance products around.
I think you're right, Phil. The industry in this country represents about 1,800 separate entities, and with those
1,800 separate insurance
companies. And in those companies, they each offer approximately 25 different products. And we find whether an individual is a high school graduate or has a PhD, nowhere in the educational process has that individual had the opportunity to really find out about the differences in product and the differences in the types of plans that are available.
Well, Ed, one of the reasons that I invited you here tonight was really to help educate the audience about insurance and the industry. And let's go back. I want to pick up a remark you just made in your comment a moment ago. You mentioned that there are 1,800 companies, and these companies, in effect, all are developing their own unique kinds of products. Is that true?
That's right.
They're all engaging in product development, essentially.
That's right, Phil. Through the actuarial department, these companies design individual products, and I think, again, the average consumer is confused because the differential between one product and another might be very subtle. And knowing what questions to ask sometimes is the key in analyzing whether this product fits into the individual's portfolio or not.
Right. Let's describe product development so the viewer understands it. In the old days, product was life insurance, certainly, straight, ordinary life insurance.
Right.
The breadwinner would be insured, and the view would be that if that man, usually a male, were to die early and there were a wife and children left, the insurance, the lump sum from the insurance would carry the widow through until the kids were educated or out in the business world.
That's right. We're specifically talking about life insurance products. Here, there are two basic functions a life insurance policy would provide. One would be in the event of premature death of the breadwinner. The second would be more of the estate planning type product, which is a more sophisticated application where we're normally involved with attorneys and trust documents providing for estate liquidity.
Yeah, but Ed, I want to stay with this product development for a moment. Now, if there are 1,800 companies and 1,800 companies were selling life insurance, simple life insurance, all those products were the same. They were all automobiles that did the same thing.
Well, I think what happened, Phil, was that a lot of people looked at life insurance not necessarily as an investment. Therefore, they didn't look at some of the subtle differences and even pricing among different contracts. We've seen today, based on reviews of AM Best, a company that analyzes the insurance industry, that indeed there are substantial price differences. And as the consumer has become more knowledgeable, certainly there are different types of indexes and methods he has to compare different contracts.
Okay, let's go back for a moment because you're using the term contract. When one enters into an insurance agreement, one enters into a contractual relationship.
That's correct.
Just as if the same kind of contract that you would sign if you bought a home, or I don't know, that maybe a pro ball player would sign.
Right.
So I know the company commits itself to doing certain things that's it's part of the contract. Pay in the event of death.
That's right.
Okay. Where does the consumer commit himself or herself when they sign a contract?
Well, you have a situation where when a contract is entered into, it's the insurance company that is making all the guarantees. The consumer does not have an obligation to continue that policy. He's certainly not bound to that contract. It is the insurance company which is making the guarantees, which normally are premature death, disability, if it's a cash value type policy at retirement, There have to be certain internal annuity tables built into the contract which guarantee income. Various features like this which are assured by the company.
You mentioned the AM Best company.
Right.
The AM Best company, I guess, is in my business being as a stockbroker, the AM Best company is comparable to Standard & Poor's or Moody's. They were a rating company.
That's right. AM Best is an independent analyst of the insurance industry. They have been doing this since 1899.
What kind of ratings do they put on insurance companies?
They would rate companies anywhere from A+, A, B+, B, C, to unrated.
Now, my naive assumption would be, or my naive assumption before I got a little training in it, was that an insurance company is an insurance company, and what need is there to look for a rated company or an unrated company? Why should the consumer, the person watching the program tonight, be concerned about the rating of an insurance company?
Well, I think that the answer to that is perhaps illustrated by the fact that there are, since these are legal reserve insurance companies and the money is not guaranteed by the U.S. government, as you would have in a savings account, FDIC, FSLIC, I think the financial strength and integrity of the company, the track record of the company, should be very important.
Ed, most viewers out there don't know the terms, the jargon.
Okay.
Legal reserve. You're going to have to both
Okay.
be. You're going to have to both offer information
Right.
and be the dictionary at the same
Okay.
time. You've got a tough job.
Well, a legal reserve insurance company is basically set up on an individual state basis. In other words, we have in the United States 50 separate departments of insurance. And like the banking industry,
Each state has got its own Department of Insurance.
that's right. And like banks, which are required to keep a certain amount in reserve to protect the assets and the liabilities they have, insurance companies also do. I think, therefore, what we're looking at when you're considering an AM Best report would be the assets to liabilities ratio, would be net yield on invested assets, those types of things which, quite frankly, would vary from company to company.
My understanding is that the insurance industry has had an extraordinary record of safety, or not so much safety, but an extraordinary record of not having defaulted on claims.
Well, this is true. I think we're not necessarily going as far as to say a company would default, as we are in terms of price differential and actually competitive return to the client.
Yeah, but for a moment, for example, we have had things in your industry which have left a bad taste in the mouths of some people. We've had equity funding,
Right.
which, by the way, had its history right here in Fort Lee. You know, they had a problem here in Fort Lee. We had the annuity company that went bankrupt a couple years ago, the big one.
Baldwin United.
Baldwin United, right. Now, the industry has come along and, in effect, helped the consumer when the equity fundings of the Baldwin Uniteds of this
Right.
world come along. Describe that process.
Well, the equity funding situation, which was really a combination of collateralizing your life insurance with a series of mutual funds, that was kind of sort of a hybrid product in that the insurance industry was underwriting the term insurance element of that contract, but the mutual funds were not directly regulated by the insurance company. I think more realistically...
So the mutual funds were not guaranteed by the legal reserves.
That's right. It was a play on the use of insurance as collateral in the purchase of mutual funds. And they were not directly tied together.
And the company was indicating a hybrid where they were saying, hey, you've got the best of all possible worlds. You've got the world of safety and the world of capital appreciation in the stock
right.
market.
Most recently, I think people are aware of the Baldwin United situation or the charter situation. And again, in these scenarios, the Baldwin United situation, clients have not at this point lost the funds that have been invested there. What we're looking at now is that in the state of Indiana, which was the home office of that company, that's still in litigation. It appears while the clients will receive back these were annuity contracts, get back their original investment, they may not get the high interest rates.
Okay. The point I'm really getting at, my understanding is that when major insurance companies, companies get in trouble, the industry bands together on a collective basis tends to come along and bail out the consumer. Is that a fair observation?
Right. That's right. As a matter of fact, what you'll see here with people who had the charter annuity contracts.
Charter went bankrupt, did they?
They didn't go bankrupt. None of these have actually gone bankrupt. Neither Baldwin United, they're in a reorganization process, or Charter were bankrupt. The charter situation, which was eventually taken over by Metropolitan Life, guaranteed all principal and prior interest credits were transferred to Metropolitan, as you're suggesting, Phil. They came to the rescue.
So
and those individuals are actually guaranteed 11% for 3 years.
MetLife was the bailout agent.
That's right.
For both for their own good and for the good of the industry.
That's correct.
We've had comparable things, as you may know, and you've been with Merrill Lynch now, I think, about 5 years. Is
2
it?
years. 2 years.
2 years, I'm sorry. But you've been in the industry for...
I've been in the industry since 1979.
Okay. Many years ago, we had a serious failure with Goodbody, the brokerage firm, and in effect, Merrill came along and absorbed the Goodbody clients, and for the integrity of the industry, bailed them out, but bailed the industry out. And I guess there's kind of a precedent here in the financial industry where strong people come together to protect the consumer. It's a way of maintaining belief in our financial system, our financial markets.
That's right. One of the things that you would consider in the insurance area is the fact that any company that's licensed in the state of New York, which is very close to us here, any company licensed in New York that has an insurance pool, and all the other companies in New York do stand behind any other contract.
Do other states have that, or is New York have a higher degree of safety than other sister states?
New York, all I would suggest is this, that a New York licensed company certainly has that added feather in its cap.
So it's a more rigorous environment to
That's
do
right.
business in.
That's right. Although in terms of the safety of insurance contracts in general, no one in this century has lost a penny from a life insurance company.
Why? Because of the
I think you'll find, and again, if we're talking about 1,800 companies, two of the examples we mentioned here, the Baldwin United and Charter, represent a very small percentage of all funds that have ever gone into an insurance contract. So I think the safety and security is second only to funds that have been guaranteed by the U.S. government.
Now, I hear another term used in the insurance industry. The term coinsurance frequently comes up. Is that a safety device for the consumer as well?
Well, the feature of coinsurance is more often found in health insurance contracts.
Or why don't you describe that process, or describe what coinsurance is?
Coinsurance, there's a difference now. Coinsurance or reinsurance?
I'm not sure. I'm more
Okay.
I'm more concerned about helping the consumer understand.
All right. Well, let's stick
the
in the
industry
area.
and the
Let's
process.
stick in the area of life insurance for a second,
Okay.
because reinsurance is a phrase which is used where you may have a substantial carrier, for example, Manufacturers Life, international in scope, yet they will retain
A multi-billion-dollar.
$9 billion of assets.
Uh-huh.
They will only retain life insurance on one life to the extent of $5 million. Beyond that, they go to reinsurance pools. So they are even spreading their risk.
And they lay off the insurance beyond $5 million to several other companies.
That's right.
So if that one individual should die or get killed, the loss is spread over many providers or many companies.
That's correct. By doing that, they're protecting the dividend scale, and the dividends, which are in effect investment experience that the company receives, which are passed through to the customer. They're protecting that in the event of substantial loss.
And that's the way the industry really, and this is the guts of my questioning, that's the way the industry enables itself to participate and not get devastated by catastrophe.
That's right.
So, for example, if a hurricane comes along for a casualty company, that hurricane's damage is really spread amongst many, many insurance companies.
That's correct. That's
Uh-huh.
correct. Spreading of the risk. The basic concept of life insurance is, or any insurance contract for that matter, is the law of large numbers working for that financial
I was hoping you would get to
institution.
that. Good.
The law of
Tell
large
us about the law of large numbers.
Well, as you've indicated, even in a catastrophe situation, rather than one carrier be responsible for insuring all the loss, they spread it among a pool of carriers. And in so doing, they even have the large numbers working for them. For example, if you, as a family man, were to say, well, I'm not really a believer in life insurance and I am not going to buy life insurance for my family, you may or may not win that bet. You may live to the extent that your family would be grown and then the insurance would not be needed. Then again, if something were to happen to you, your family is without the source of funds. The insurance industry, on the other hand, could insure that obligation for you, and where you and I and maybe 5 other individuals would be insured, statistically, we're all not going to die, but one of us will. And they can use the funds they've received from the other individuals to help offset that. So you can see there the concept of how the law of large numbers works through an insurance company. But as individuals, we don't have that same benefit.
In effect, then, all companies participate in this reinsurance. So Metropolitan, although they're a direct writer, or a Prudential, also buys insurance from other companies to help spread that risk?
That's right. Depending on the size of the contract they'd be underwriting, they would have reinsurance agreements.
Mm-hmm. Ed, we're almost at the end of the segment. We're going to have to pause in just a moment for a commercial. So stay with us while we go into a commercial, and perhaps then, Ed, you can help us understand some very specific products over and above the general atmosphere of the industry. We'll be back with you in just a moment. Thank you for staying with us. My intention in producing this program was to help you understand a little about the insurance industry. And as I told you before the commercial, my guest is Ed Bayarski, who is a regional marketing and regional insurance specialist for Merrill Lynch. And basically, he doesn't deal necessarily with the public, but he deals with the Merrill Lynch salespeople in terms of training us to properly offer product to you. So Ed is kind of a college professor in this area, and you can learn a lot about insurance and the origins of insurance from him. As a matter of fact, now we probably will do a little on a blackboard, this segment of the program. Ed, the first part of the program before the commercial, we kind of hit highlights of the industry and basic theory about insurance, the law of large numbers, the fact that insurance companies survive because the risk is spread over many companies. Nobody really gets destroyed by a catastrophe. But could you run us through the process? I know you brought your chalkboard. You seem to be immobile without your paperboard. Could you run us through the process of showing us how product develops? Let's say you've got a basic life insurance line. How does, from life insurance, which is very elementary and has been used in this country for many, many years, if not decades or close to a century, how has that evolved where you now have other products that are appropriate for estate planning or other kinds of accumulation of money?
Great, Phil. I'd like to take the opportunity to do that. I think the board will be helpful to us. And that I think a picture's worth 1,000 words. And what we're able to
let's show the picture.
Yeah.
I didn't know you were an artist.
Yeah, well, John Nagy, right? We all grew up with John Nagy.
Okay.
And what we're looking at is a situation where, when the life insurance product, for example, was first designed, what type of product was there? And the answer to that is there was death insurance and it was term insurance. You insured the risk each individual year. So if you looked at it as a picture, it would look like this. The premium would go up as you were getting older and therefore getting closer to dying. The problem with this type of approach is, as you get to your later years, people cancel it because it becomes much too expensive.
So here, insurance for a young person in his 20s would be relatively inexpensive, and if the person goes to 30, 40, 50, on up, the longer they live and the longer they carry the insurance, the more expensive it is to carry the insurance. Is this straight life insurance?
This is term life.
Life.
It's term life.
Okay.
And I would say this, that less than 1% of all the term insurance policies ever written result in a death claim. Primarily because it's the great place to get from point A to point B, assuming you could define those 2 points, and assuming that you're not going to need it for an extended period of time.
So the companies made out, but the consumer didn't.
That's right.
The consumer had no cash buildup.
That's right. So what the industry did was, in the beginning of the 1900s, they came out with a level premium concept. And this is, Phil, where the concept of whole life developed. What we did here was to take a level premium, which was obviously more than we needed to insure the risk in the early years, so that later on, rather than the premium go up, it was to stay level. The result of that is the regulators, and I mean the departments of insurance, required that since there was a greater premium required than to cover the mortality charge, you develop something called cash value. This is where whole life or cash value insurance evolved from. Now, there are many types of whole life. There's 20-pay life, there's life at 65. You'll hear a lot of different names, like extraordinary life. Every company has a different name. But that was exactly what happened. Now, this was going along very well till the mid-60s and early 70s, when, as you know, Phil, interest rates kicked up, and where whole life, according to the Federal Trade Commission, was paying 3 to 4% on policy cash values. The individual consumer said, I can do better than that in a money market account. He therefore pulled all his cash value out of his life insurance. A lot of people actually canceled the insurance, or they borrowed against it. The concept that they can get a higher rate of return than was currently available through the insurance industry. As a result of this, the insurance industry went through a process of what we call disintermediation, which means every day when they opened up their mail, they had more requests for money to leave the company than they had new premium coming in.
Money is being moved from one financial institution to another usually to get a higher rate of return in the
That's right.
second institution.
That's right. So this is what happened, and we saw major withdrawals being made from the industry. What happened then was in the early 80s, a new contract was developed, which I'm sure a lot of your people listening tonight have heard about, which was universal life. And what happened with universal life was this. We went to a new approach. Instead of money going into a cash value contract, which had heavy front-end sales charges, and it had a terrible investment performance, we designed a new type of product where dollars could be invested, and the client could determine within certain parameters how much face amount of insurance he wanted to cover, wanted to have. What would happen is, to that fund, we would add an interest credit. These rates were as high as 12%. We're seeing most companies today between 8 and 9%, which is still higher than a money market type of fund.
Now let me understand this.
Right.
In universal life, people have an ordinary life insurance policy in here.
That's right. This is life insurance.
Okay. So if a male who is now 40 dies at age 55, his widow is guaranteed a certain amount of life insurance.
Which would be substantially greater than what he'd invested to that point. That's
Okay.
right.
But there are additional benefits in this policy, this contract. Now tell us what those benefits are.
Well, one of the benefits is certainly the higher interest rate. The thing that the important criteria, though, is because there is going to be a charge here. We all know there's no free lunch in life, and someone has to pay for this coverage.
I'm reminded of that frequently.
So they're going to subtract out the cost of term insurance from this account. Now, I think what the consumer needs to look at is what are the charges going in? What are the sales charges? In other words, for every dollar that he puts in, does 90 cents get into the account? Does 95 cents get into the account? Does 98 cents get into the account?
Now, when the consumer is buying insurance from a salesperson such as yourself, although you usually don't sell to consumers, you will break those numbers out for a
That's
consumer
right.
and tell them what they're paying?
This has been a godsend to the consumer, and that for the first time, the consumer actually knows how much of his money is cost and how much of his money is interest and how much of his money is the insurance cost. Client receives an annual statement, and on the annual statement, it will break it down for him monthly to show him exactly what it was. Just like a cash management account. He'll know to within 25 cents what his account balance would be at any point in time. So this was the advent of a new generation of products, and we've seen a lot of customers go from old whole life insurance into a newer universal life model. One of the things that, and you said some of the incidental benefits, one of the benefits is under Section 72E of the Internal Revenue Code, the money in this contract will accumulate on a tax-deferred basis. In other words, the money that builds up in here, earning an interest rate, is not subject to current income taxes. I'd like to add that under the new tax bill, this will not be changed. That the House Ways and Means Committee, in consideration of this new tax act, retained the cash value buildup provision in insurance on a non-taxable basis.
Ed, I don't want to take you away from your presentation. It's very interesting. But insurance is a unique product in that it has tax advantages or tax benefits or shelters that most other, if not no other product has. Is that a valid
That's
observation?
right, Phil, because under 72E, not only will the cash value grow on a tax-deferred basis, but the client has, I'm not a very good artist here, I'm afraid, but this is a spigot, and the client could take loans from his contract, also income tax-free. Most contracts today have a situation where the net cost to borrow funds from your contract is 2% a year. That will range from 2 to 4. Obviously, if you shop around, you could find a contract with more competitive terms. So here you have absolute ability to accumulate money cash tax-free, remove money tax-free as a loan, and if you maintain the policy until you die, the death benefits are tax-free. So if managed correctly, the consumer should not ever pay taxes on this. The only time, and the gotcha, the time you would pay taxes is if he cashes the thing in. If he collapses this type of contract, you're going to find that all the earnings have been tax deferred. The principal comes back to you non-taxable, but your gain would be taxable.
So the average, the insurance consumer, when he or she buys insurance, in the back of their mind should tell themselves they're better off by buying insurance and not really cashing in, but keeping it as a part of their estate. Is that?
That's right. A lot of consumers today are looking at this as part of their investment portfolio. that this is an asset that they should manage like any other asset.
Now, this asset can be, ultimately would be passed on either through, well, through the will to the wife, if the wife is the survivor, or children, if the children are the survivors.
That's
and
right.
those people are receiving an asset, in effect, that taxes have not been paid on the asset that are coming in, into
That's
their
correct.
hands.
That's correct.
The asset that is coming into their hands.
The benefit here can be structured in such a way so that the surviving spouse receives the proceeds, income and estate tax-free. Under current tax law, there's an unlimited marital deduction, which means mom to dad and dad to mom, all assets pass free of any taxes. If there was a larger estate, over $2 million, for example, then you would want to position this in some type of insurance trust. And if properly structured, would avoid inclusion in both estates.
Well, Ed, how far can this go? And I know my question is somewhat of a digression. How far can this go? Can this go on to the next generation, the next generation, the next generation?
Well, realistically, what you want to do is, again, if the money was put in here, for example, let's say a customer put in on a single premium universal life contract, put in $25,000 as a lump sum deposit. And he said, I'm just going to let the money go in there. We can do this where 100% of the money is invested. There's no front-end charge. The client can earn interest on this. He would be insured, if it was a male 45 example we used earlier, he'd be insured for approximately $100,000. What would happen is if this 25 grew over a period of years and he were to die, the family would get all the proceeds plus the death benefit here, income tax free, and therefore there would really not be a reason to continue the contract. Now, one of the new things that we've seen, Phil, also is as interest rates have come down, some companies have gone to a new concept which is known as variable life. And what we've done...
Can we go to a new piece of paper?
You want to go to a new piece of paper?
Yeah,
Fine.
yeah.
Okay.
I think your artwork is starting to get crowded.
With variable life, it was the same type of situation. But Andrew Tobias wrote a book called The Invisible Banker. And he said that he likes the tax advantages of life insurance and he likes the protection, but he wouldn't want an insurance company managing his money. Well, with variable life, what we've been able to do is come up with a concept where the customer could buy into no-load mutual funds. And you know the story with mutual funds. In recent years, they've become extremely attractive. The customer could range anywhere from a money market to a government bond fund, a corporate bond fund, a stock account. He can even buy U.S. zero-coupon treasuries. My shorthand there. The client can get all the same type of arrangements that we discussed earlier. He can arrange this so his money's invested and that he can have it grow tax-free, he can remove money tax-free, he can switch from one account to the other tax-free. Recent articles in the New York Times and U.S. News and World Report have said this version of life insurance is one of the hottest tax shelters on the market.
Well, Ed, if someone buys a contract like this, and I assume that's the way you talk about insurance, you buy contracts. This is a rather complex kind of product. 2, 3, 4 years downstream, does the consumer get direction either from you or the broker or from printed paper so he knows how to manipulate the options, so he or she knows how to manipulate the options?
The consumer receives a quarterly report on this contract showing the equity position, showing the insurance position. By the way, I would like to add there's a lot of flexibility in terms of the spread between the insurance and the amount of premium that's being deposited. But he should work with his financial advisors in terms of designing this portfolio so that he could maximize the yield that he receives. And yes, it should be managed like any other asset.
I really thank you for being here tonight. I'll be back on Money Corner again next week. Have a good weekend. Good night.